Hello everyone, welcome to Business School 101. Profit means success for a business, and executives should be able to calculate that bottom line. Analysts use profit as a measure of a business's worth, helping investors make appropriate decisions. In some cases, individuals may be required to use basic math to calculate profit on their own. So what is profit? What are the differences between gross profit, operating profit, and net income? What is a profit margin and why it is so important? In this video, I will discuss these questions with you. Section 1. What is profit? Profit is a term that often describes the financial gain a business receives when revenue surpasses costs and expenses. For example, a girl at an ice cream stand spends $1 to create one ice cream cone. She then sells it for $3. Therefore, her profit on that ice cream cone amounts to $2. In the real business world, profit can sometimes be a bit more complex as there are three types of profit: gross profit, operating profit, and net income. Let's discuss them individually. Section 2. Gross profit. Gross profit is the total revenue less only those expenses directly related to the production of goods for sale, called the cost of goods sold, or COGS. Please keep in mind that the COGS is the cost of acquiring or manufacturing the products that a company sells during a period, so it only includes costs that are directly tied to the production of the products, including the cost of labor, materials, and manufacturing overhead. For example, COGS for an automaker would include the material costs for the parts that go into making the car, plus the labor costs used to assemble the car. However, the cost of sending the cars to dealerships, the cost of advertisement, and the salary of the sales team would be excluded. In addition, gross profit is referred to as gross because it does not deduct debt expenses, taxes, or all the other expenses involved in running the company. Section 3. Operating profit. Derived from gross profit, operating profit reflects the residual income that remains after accounting for all the costs of doing business. In addition to COGS, operating profit needs to subtract fixed cost expenses such as rent and insurance, variable expenses such as shipping and freight, payroll and utilities, as well as amortization and depreciation of assets. All the expenses that are necessary to keep the business running must be included. However, like gross profit, operating profit does not account for the cost of interest payments on debts, tax expenses, or additional income from investments. Sometimes, operating profit is also referred to as earnings before interest and tax, or EBIT. However, EBIT can include non-operating revenue, which is not included in operating profit. If a company doesn't have non-operating revenue, EBIT and operating profit will be the same figure. In other words, operating profits only reflect the profit and efficiency of a company's core business. Section 4. Net income. Net income, also called net profit, reflects the amount of revenue that remains after accounting for all expenses and income in a period. Net income is the last line and sits at the bottom of the income statement. As a result, it's often referred to as a company's bottom line number. From the operating profit figure, debt expenses such as loan interest, taxes, and one-time entries for unusual expenses such as lawsuits or equipment purchases are all subtracted. All additional income from secondary operations or investments and one-time payments for things such as the sale of assets are added. Net income is arguably the most important financial metric, reflecting a company's ability to generate profit for owners and shareholders alike. It's important to note that a company can generate a positive number for operating profit, but have a loss or report negative net income. For example, a company generates $100 million in operating profit, but if the interest expense was $110 million for the period, the company would record a $10 million loss in net income, despite producing $100 million in operating profit. Section 5. An example. Let's use ABC Electronics income statement as an example. As you can see, the company's sales revenue is $200,000. Its cost of goods sold is $110,000. Thus, its gross profit should be sales revenue minus the cost of goods sold, $200,000 minus $110,000, which equals $90,000. To calculate the operating cost, we need to use the gross profit minus all operating costs. In this income statement, we can see that ABC Electronics incur 5 types of operating expenses, which are advertising cost, $5,000. Payroll and commission cost, $35,000. The rent cost is $6,000. Office equipment cost, $1,500. And the utility cost is $700. In total, the operating expenses are 5,000 plus 35,000 plus 6,000 plus 1,500 plus 700 equals $48,200. Therefore, the firm's operating profit should be gross profit minus the total operating costs, which is 90,000 minus 48,200 equals $41,800. Lastly, to calculate the firm's net income, we need to use its operating profit to add the firm's other revenues minus its interest cost and taxes. Within the form, you can see, the firm has an interest revenue of $2,000. Gains from investment sales is $1,500. But it also needs to pay $600 interest and $200 tax. Therefore, the firm's total non-operating items equals to $2,700, and its net income should be $41,800 plus $2,700 equals $44,500. Section 6. What is the profit margin? Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or a business activity makes money. It represents what percentage of sales has turned into profits. Simply put, the percentage figure indicates how many cents of profit the business has generated for each dollar of sale. For instance, if a business reports that it achieved a 35% profit margin during the last quarter, it means that it had a net income of 35 cents for each dollar of sales generated. In accounting and finance, there are various ways to calculate the profit margin. Here we only introduce three primary margin ratios, which also correspond to three different types of profit: gross, operating, and net. Below is a breakdown of each profit margin formula. The profit margin is a globally adopted standard measure of the profit-generating capacity of a business. Different business participants can use it in various ways. For example, first, business owners, company management, and external consultants can analyze profit margins internally for addressing operational issues and to study seasonal patterns and corporate performance during different timeframes. Second, large companies operating multiple business divisions, product lines, stores, or geographically spread out facilities may use profit margins for assessing the performance of each unit and compare it against one another. Third, small companies may use profit margins as proof to seek funding. For example, a local retail store or an auto body shop may need to provide the profit margin for seeking a loan from banks and other lenders. Fourth, investors consider the profit margin a critical indicator to evaluate a firm's performance and potential. Investors looking at funding a particular startup may like to assess the profit margin of the potential product or service being developed. Section 7. What is a good profit margin? Profit margins vary from industry to industry, which means that companies in different sectors aren't necessarily comparable. For example, a retail company's profit margins shouldn't be compared to those of a technology company. Below is a comparison between the profit margins of 4 long-running and successful companies in the technology and retail space. As you can see, technology companies like Microsoft and Alphabet have high double-digit quarterly profit margins, compared to the single-digit margins achieved by Walmart and Target. However, it does not mean Walmart and Target did not generate profits or were less successful businesses compared to Microsoft and Alphabet. To sum up, regardless of what industry the company competes in, business owners need to review their competition, as well as their own annual profit margins, to ensure they're on solid ground. Alright, that's all for today's topic. If you have any questions regarding this video, please leave your thoughts in a comment below. I hope that you guys have enjoyed this video, and if you did, make sure you give it a thumbs up and subscribe to my channel. Thanks for watching, and I will see you next time.